term hedge fund gets used a lot, and often by people who aren't even quite sure what it means. The term evokes the thought of hedging, but also evokes the idea of mysterious funds making huge amounts of money the market can't see until they've done it. And perhaps part of their mysterious nature is that there's no really clean definition to describe exactly what a hedge fund does. They're investment partnerships. But what exactly do they do? Well, there are all sorts of things that a hedge fund can do. So many strategies that it's somewhat difficult to say they're all one type of fund. Now, there's no real limit to the strategies that a hedge fund could use, but today I'm going to go over some of the more common strategies that are seen amongst hedge funds. So these are 10 hedge fund strategies. Managed futures are portfolios of futures contracts. Now, they can be fully discretionary, and that the manager makes all decisions, or they may be rules-based, where a set of rules determine what futures are traded and when they are traded. Very often, they're treated as absolute return funds, where the returns aren't pegged to any underlying benchmark, but are more likely to be pegged to something like a cash rate plus a basis point spread. They are very often invested in, and they outperform in times where there's very high volatility in the markets. And quite often, this is when there is a strong sell-off that's happening in the market. So they're used in a portfolio as a hedge against other positions which may be falling. Most managed futures funds typically have the freedom to go long or short a futures contract. And very often they'll have a combination of both, where some contracts they are long and some contracts they are short. When a managed futures fund is rules-based, there's a set of rules that are determined ahead of time that the fund follows, and these rules decide when buying and selling happen and what will be bought and sold. In this type of fund, the decision-making is done ahead of time, and the rules are what determine the success of the fund. In a discretionary fund, decisions are left to the managers and traders, who determine when and what to buy. This affords the fund a lot more freedom to take opportunities, and the success of the fund is dependent on the decision-making of the manager or traders. Frequently, there are funds that are a hybrid of the two, where there's an overarching rule set that determines the general strategy that's followed. However, there's freedom afforded to the manager and traders to vary from that. This allows them to seize on novel opportunities or to deviate from the rules when there's a belief that the rules don't accurately reflect the best course of action that the fund should take. Convertible arbitrage is a strategy which is based around convertible bonds. Convertible bonds are bonds where the bondholder has the right to exchange those bonds for some number of company shares at a set price. And the idea is that if the company's shares are at a higher price than what the conversion price is from the bond, then the bondholder would want to convert those bonds into the shares. In effect, giving up the bond to be able to buy shares at a price below market price. A commonly employed strategy is to short the stock of the issuing company and buy its convertible bonds. The idea is that if there's mispricing and the fund expects that the shares will decrease in price, then the fund will profit from the short position on the stock. However, if the shares were to rise in price, then the fund would have a hedged position on their short because they are long the convertible bonds. So the fund can convert those bonds into shares of the stock. And the difference in price that the stock is from the conversion price on the bond, that amount will become a gain to the fund from conversion. Event-driven strategies can mean quite a lot of different things. Generally, it is an attempt to profit from some sort of corporate event and any mispricing that's around it. One very common type of event strategy is merger arbitrage, where the fund attempts to profit from an upcoming merger. Now, different acquisition deals vary greatly, so this isn't a universal strategy It depends on how the deal is set up and what is being exchanged. But a common form is buying shares in a company that is going to be acquired. Typically, after a merger is announced, the share price of the company to be acquired, the target company, jumps in price, but it doesn't jump all the way to the acquisition price. This is because there's some little gap on the possibility that the merger deal falls through. So if the merger arbitrager expects that the deal will go through, then the fund will take a position in the target company and attempt to profit as the share price of the target company makes that last little gain as it moves to the acquisition price. Another form of the merger arbitrage trade is going long the share of the target company and short the share of the acquiring company. And it's fundamentally the same idea. The target company gains in price, except not all the way to the acquisition price, and then it makes that last little gain as the deal actually happens. However, there's also the short end, and the idea, very frequently, is that the acquiring company is paying more than the net asset value of the company, so now the net asset value per share of the new company should go down. But there are different ideas as well as to why the share price of the acquirer might decline. It could also be that if the deal doesn't go through, it'll be seen as a loss to the acquirer who missed out on a good business opportunity, and so their shares will decline in price, and the fund will gain from that short position. Here it really varies based on the specifics of the deal and what the fund expects to happen. The idea of a market-neutral fund is to have a fund with no exposure to the market. Using equity market neutral as an example, it would have a target beta of 0. What the fund tries to do is profit only from idiosyncratic gains of specific securities and assets. A form this could take is to go long a stock or specific stocks and to short the overall equity market. Perhaps this could be done by shorting an index fund. Now, this has to be done in a proportionate way so that the net beta is around 0. So in this trade, the fund will lose on any gain in the market and gain from any loss in the market, and it will be long the stock, profiting from an increase in stock price and losing from a decrease in stock price. So what ends up happening as a result is that the overall return is the return on that specific stock or stocks less the return on the market. The return is the return of the stock without any return that's attributable to the market. And the ideal scenario for this is to profit from the gain of a stock in a down market and be short the market in a down market, so now any drag from the market, the inverse of that, is now a gain to the fund. But this is generally used as an uncorrelated strategy. The idea is to have a fund that has its returns unrelated to what the overall market is doing. Now, this was a pretty simple example, and there are many different forms that this strategy can take. But the overall strategy remains the same. Profit from specific assets and subtract the market out of it. Long-short funds vary in strategy a great deal, but what they all have in common is that they have the ability to go long and short. And the weights they assign to each of these vary considerably. They could be even so that their long and short positions net out to neutral, but very frequently you see a greater than 100% allocation, where cash from the short position is used as leverage to buy more long positions. For example, 25% short gives an additional 25% to the long portfolio for a 125% long position paired with it. And these weights can vary between managers. And the idea is generally to go long on what you expect to go up, and to go short on what you expect to go down, or something you want to hedge out. Frequently, this is done by first entering into short positions. Then take the money that was received from the short position and use that to buy into long positions. Because that short position required debt, there is now leverage which the fund manager can employ. And using any money from the short position to enter into long positions allows the fund manager to have a greater than 100% long position. Short-only funds or dedicated short funds are a pretty straightforward strategy, and it is all of the positions are short. Now, one thing that's been seen is the phenomenon of activist short sellers, where a short seller issues a public statement or report about a company that is being targeted for short sale. And they might write about why they expect the share price of the company to decline, or problems they see with the company or the macro environment. They are putting out the idea of why the company should be worth less while having a short position in it. Now, this is not an inherently illegitimate thing to do. There are fantastic short managers who provide a very vital market function with what they do. One great example is Jim Chanos. But it's also a tricky area to watch because there has also been plenty of libel and slander that has happened in this area. There have certainly been examples of short sellers using fraudulent reports and not disclosing their positions in order to get their short positions to profit. For this reason, there's very often skepticism around short reports. Statistical arbitrage attempts to profit from the reconvergence of two assets which have historically been correlated but have become decoupled as they reconverge back to their prior relationship. A statistical arbitrager will typically see two assets, either ones that have a reason to be correlated or have such similarities that it makes sense for them to be correlated with each other. Then, if they have diverged from that relationship, take a long and short position and attempt to profit as they come back to their relationship. Say there are two assets which typically trade together, either at the same price or say a ratio of 2-to-1 between them, and now one is much higher in price than expected in their relationship, and one is lower in price than was expected in their relationship. The statistical arbitrager will take a long position in the one that is lower than expected, and a short position in the one that is higher than expected. And hopefully the one that is higher in price comes down, where the short position wins, and the one that is lower comes up, and that long position wins. This strategy, however, doesn't say where the prices should be. It could be that the one that is higher in price is at the correct price level, and the one that's lower in price is wrong, or the lower price is correct and the higher is wrong. Or both of them are completely wrong and they're both too low in price, but the relationship is off. Or they're both too expensive and the relationship is off. For this reason, statistical arbitrage is focused entirely on the relationship between the two prices and not the price levels themselves. Say they are both too high in price. Well, the short position on the one that's higher in price will profit from going down, and the one that is lower in price, there will be a loss on that leg because it goes down. But there will be greater movement on the short end, causing the net trade to be profitable. Or they could both be too low in price, and so they both go up. The one that is the long position would gain, but the short position would lose. However, that long position would have a greater gain than the short position would be a loss, so it ends up being a net profitable trade. Now, this might just sound like free money, but there are plenty of risks to this strategy. And there is one very significant risk. And that is these relationships, even ones that have lasted for a very long time, they might break. One very notable example was the relationship between silver and gold. For a very long time, silver and gold had traded at a reliable ratio, deviating and coming back. And there were arbitrageurs who were profiting from this. And it worked great. It was such a reliable way to arb some profit until it wasn't. They diverged and the relationship broke. And that ratio that had been there for years and years and years was just gone. So arbitrageurs attempting to profit from that reconvergence, well, they found out the hard way. Carry trades are a global macro strategy, and there's a lot of money in funds doing this strategy. And part of the reason is because it's such a heavily levered strategy. The idea behind it is to borrow in one country's currency and to lend that money in another country's currency. To make an example, say a carry trader borrows money in currency A. Since borrowing costs money, there will be an interest rate that has to be paid, say 1%. The trader will then take those borrowed funds to buy currency B, somewhere where there is a higher interest rate. Then in that country B, the trader will lend that money. Since the trader is now lending, the trader will get that interest rate. Let's say, for example, 5%. Typically, this is done by buying fixed income securities like money markets. So now the carry trader's in a position where he's paying 1% and getting paid 5%. So on net, that's a 4% return, and with borrowed funds. That isn't the only component of return, however, as at the end of the trade, currency B has to be exchanged back into currency A, so the carry trader gets any gains or losses on the change in exchange rate. Since the trader is long currency B and short currency A, if B gains in value relative to currency A, then that's an exchange rate gain. And inversely, if B loses value relative to A, then that's a currency loss for the trader. Now this one has some serious risks, and they're particularly magnified because this is such a levered strategy. One risk is default risk. For the currency that the trader is lending in, what if the borrower doesn't pay it back? Well, that's one risk. Then the one we already discussed, change in exchange rates between the currency. That could move against the trader. And one very, very notable one is changes in interest rates. And this can cause carry trades to be unwound en masse in very large scale. I find funds of funds are fund funds. Funds of funds fund funds. And are funds that are funds of funds. Yeah. So funds of funds are I'm not doing it again. Funds of funds take positions in multiple hedge funds or in multiple strategies of their own. The idea is that the performance of the fund overall is diversified across multiple hedge strategies. Investors often like them because instead of picking multiple hedge funds, investing in a fund of funds can offer exposure to all sorts of hedge strategies in just one fund, so that there's only one place that needs to be invested in order to get that uncorrelated exposure. One issue which has arisen with funds of funds is that they may have higher fees if they are a fund that is investing in other hedge funds, and there are two layers of fees: the fees from that initial hedge fund and the fees from the fund of funds, which has historically made them very expensive at times. The idea of distressed investing is to identify assets that have been heavily pushed down in the market, or ones that look like they're in a very bad spot. A distressed investor will look for assets that are either in a better spot than the market recognizes, have more upside than is reflected in the market, or have more residual value than is being priced in. A very common form of distressed investing is taking positions in the assets of a company that either is going to go through bankruptcy, or one that is in a position where it looks like it is very likely that it will go through bankruptcy in the future. Distressed debt investing is taking positions in the debt of a company that looks near bankruptcy, or taking positions in the debt of a company that looks very likely to default on its debt. There are multiple reasons an investor might do this, but some common ones are that the assets might be oversold on too much pessimism. The investor might expect a better future for the asset than the bleak future that is being priced in by the market. The investor might believe that in bankruptcy proceedings, more will be gotten out of the company than the price to acquire the asset. And generally, the investor might expect a recovery or a payment on debt that the market is not expecting. There are so many really interesting strategies that hedge funds have used, and there are some incredibly interesting hedge fund investors that are well worth listening to. I'll be talking about more investment strategies in the future, and I hope you enjoyed this video. And if you enjoy this finance series, then please do subscribe. So, for now, have a neat day.